Let me introduce the panelists to you. The panel topic is New Global Order, New Market Behaviour. I'll try to explain what that means in a couple of words in a moment. First of all, let me introduce the panelists from right to left as you see it. Keith Wade is the Chief Economist and Strategist at Schroeder Investment Management Limited here in London. Arunma Ote is Vice President and Treasurer at the World Bank. Delighted to have you back, Arunma. Thank you very much. To my left, Moritz Kremer, certainly no stranger to this stage over the years, is Global Chief Ratings Officer in Sovereign Ratings at Standard & Poor's Global Ratings, based in Frankfurt. To my right is Sébastien Domenico, who is Global Head of Debt Capital Markets at Crédit Agricole. Can we call it, changes its name all the time, doesn't it?
Crédit Agricole.
Crédit Agricole. Callion, we don't say that anymore.
No, we don't say that anymore.
No, we don't say that anymore. Okay. Crédit Agricole. I just wondered if I was meant to say CA or CA or something. Louis de Montpellier, next on the panel, is the Senior Managing Director and Global Head of the Official Institutions Group at State Street Global Advisors Limited. And last but by no means least, on the left of the panel is John Cunliffe, Chief Investment Officer of Charles Stanley and Company Limited. Now, all these people's biographies are on the app. They haven't printed a workbook this year, but you can see everything you want to know about these people on the app. I'm just going to tell you, just as a little teaser, we've got, in terms of the academic qualifications of the people here, we have people who study law, engineering, economics, and divinity. So I want you to guess which one of them has, it's not me, which one of them has a degree in divinity. So whoever you think has God on his side, you'll be the judge at the end of the panel. Now, what does this question mean? What it means, let me put it in a nutshell. Yesterday, a number of things happened, obviously, but a couple of things caught my eye that seemed to me to be in contrast to one another. One was that the Russian armed forces, the commanders of the Russian armed forces in Syria and that theatre said that they were no longer going to hold off shooting down American aircraft, as the Americans had shot down a Syrian aircraft. That seems to me to be the closest thing that American and Russian armed forces have been to a hot war for quite some considerable time. And the other thing was, as already mentioned, that the Dow Jones Industrial Average hit an all-time high. Now, it seems to me that there's a great deal of stuff you can worry about in the world, but markets aren't reflecting it. John, why aren't markets reflecting it?
I think it's because we're in an environment which has been incredibly positive for risk assets over the last few years. One thing that strikes me is that global economic growth has averaged around 2.6, 2.7% over the last 5-6 years, and that's been incredibly stable. That, in conjunction with financial repression, which has seen central banks keep rates down to near zero and suck a lot of yield out of bond markets, makes risk premium on equities very, very generous and supports a pro-risk view, which is one of the reasons why, since I've been at the firm, we've been aggressively overweight equities against fixed income. And it's one that people don't like because they keep looking around the corner, looking for bad things to happen. What they can't see in front of them is a much more synchronized economic outlook, one where corporate earnings for the first time in a number of years are beginning to pick up quite strongly. And although valuations look rich against bonds, they look cheap. And I think that's a supportive backdrop and a tailwind for risk assets in the round.
Okay. Moritz, just to turn to you for a second, just put us in the picture on ratio of negative to positive outlooks in your sovereign ratings at the moment.
Yeah, it's very much as what it used to be the last couple of years. There's no change. So right now we have like negative outlooks outnumbering positive by a ratio of 4-to-1. So that's not that unusual over the last couple of years. What has changed somewhat is that much of this overhang of negativity is now in what we will be, sometimes refer to still as emerging markets, whereas sort of 5 years ago, much of the negativity would have been more in the advanced economies, in particular in Europe and the Eurozone, for reasons that we well understand. So I think there's a big sort of rotation in terms of where the ratings are affected by potential negative drift. But overall numbers have been holding up remarkably steady. And what we observe is that the markets, as you rightly describe, are taking a very positive view. So if you correlate the political uncertainty as measured by the infamous or famous political uncertainty index with the volatility in the market, you would expect a positive correlation. So the more uncertainty there is, the more volatility in the market, the more uncertainty in the market. And that actually did hold true until a couple of years ago, and since last year it actually went negative. So right now you have a situation where more volatility creates more stable markets.
I mean, the worse it gets, the better it gets.
Something's got to give here. I mean,
you regard it as a disconnect, don't you?
I regard it as a disconnect. So either the perception of political uncertainty is overdone, and we will find out that nothing is eaten as hot as it is cooked, as we say in German, or the markets will have to find a correction, especially after tapering of the ECB, and further tightening will happen. Or it may be a mix of the two, but I have a hard time to understand why uncertainty would be good for markets.
Aruma, obviously you come at these kinds of questions from a very different perspective. Well, everyone here has a different perspective in their way, but yours is quite distinct. Can you offer any explanation for this? Well, first of all, do you recognize that it's a bit of a contradiction, that what Moritz calls a disconnect is there? And secondly, can you think of any reason why it is being sustained?
Maybe the markets are just focusing on the long term and what is important, and considering that some of what we're seeing, and as Moritz pointed out, is people are getting used to the fact that there will be something new that will happen every day. I think that I do want the market to focus on the long term, and I hope that the market is focusing on the long term. And for us at the World Bank, we're worrying about the fact that the inequalities in the world, whether in country, whether across country, will continue to fuel a fractured society. I mean, I'm always struck by, over the recent past, that every time that Oxfam releases data about inequality, it's much worse than before. And if 8 people own the same wealth as half of the world's population, then that's why we have extremism. That's why the world is stretched. And so maybe we should go back to when, in 1944, and I wasn't there, and I don't think anybody here was there, the Bretton Woods institutions or agreement was set up. I mean, when you think about, when you listen to some of the Western leaders today, and you compare them to the president of China, President Xi Jinping, sometimes you wonder whether President Xi Jinping is the Western leader, and some of the Western leaders are the Chinese leaders. So maybe, maybe the world, maybe we have a new order that is essentially.
But Aruma, you don't make. Obviously, this is a loaded point to some extent, but you don't make poor people richer by making rich people poorer, do you?
Oh, I mean, I can share a few thoughts about that. I've said a few times this year that I'm shocked that we would have $40 trillion or more being invested in negative yielding assets or assets that's yielding not very much, when there are possibilities to support the poor people and still make more money. And when you have the World Bank that has a 70-year track record of helping you take the risk that you don't want to take and helping you go into these other countries. So something is just not right, where people are just, paying the Bundesbank to hold their money, when essentially they can do better. And when we've been very clear that we can support people around the world in doing better. And you mentioned in your opening remarks, that some people decided to invest in 100-year paper from Argentina. So maybe the world is starting to say, maybe there's a bit more to it than,
Maybe Luis Caputo is the best salesman on earth.
It's possible.
Now, what we need here, if only we had a head of global debt capital markets. Oh, we have. Why? Do you recognize this, the argument that Arunma makes, and can you adduce a reason why that is so? Why are people happy to pay the German government to look after their money instead of making a turn and doing good at the same time elsewhere?
Yeah, I think it's a difficult answer. I think, as was said before, the markets don't like uncertainty, and we have seen that. Having said that, despite the global order, I strongly believe that in terms of the market behavior, the market have adapted, quicker to the changes that we have seen and that we are seeing at the moment. If you look at the reaction that there was last year to Brexit, to the various elections, and I would be slightly more positive to what my colleagues were saying in terms of what we are seeing. So we have seen a lot less hiccups in terms of markets being open, in terms of the ability for corporates, for financial institutions, to tap the market. Now we are in an environment where indeed it's a bit of a shame that we see a lot of capital invested in low yielding assets, but we're also maybe in a situation where we are reaching a credit bubble. I don't want to say it probably here in front of that audience.
Oh, go on.
Yeah, but we're reaching a time where, as Andrew Bolts were saying, where everything is priced relatively tight. So we're expecting some positive news, and you mentioned it since this morning. We saw the Fed hike, probably the end of the tapering, and this could potentially create an atmosphere for re-risking, probably a new appetite for higher yielding assets, and probably some reinvestments. So if you want to see the glass half full, you would say that effectively, we should see that move, probably not towards, aggressively towards equity. And I heard, with attention, what John was saying, but probably a move towards, higher yielding assets. And I'm not going to talk about what happened in the last few weeks, but we saw what happened with the resolution in Spain. We saw with, what happened with some of the, the positive message that were given by some economists, some growth potentially, etc. This is all going, in my view, in the direction of, I don't know about new market behavior, probably a slight change in terms of...
Okay, so you're happy to discard the kinds of things that I mentioned in my preamble that appear to be quite risky and dangerous things in the observable, real political world, because markets are going risk on.
Yeah, and markets have priced it.
Is Schroders about to re-risk?
Well, I'll add a couple of comments. I mean, a lot of this is driven by liquidity, those very low interest rates, negative yields. And yes, the equity markets may look as though they're ignoring risk, but a lot of investors are going into those equity markets to seek yield. So you look at the kind of things that have done very well, the quality defensive stocks, the dividend payers have been making a comeback. And the other thing that's doing very well, of course, is technology, where people think, look, this is where the future growth is going to be. So there's a really good reason for going into those assets. I think the other point I'd make from a macro perspective, which is very important about the markets at the moment, is that there's no real inflation in the world economy, or at least not the kind of inflation that's going to worry the central banks. Because, we can see the Fed tightening policy, and you could say, well, look, volatility should be higher, the Fed's tightening, it's going to take away the punch bowl. But unless there's inflation, it's not actually going to take away the punch bowl. You're still in an environment where if the US economy was to slow very sharply, so you were talking about recession earlier, the Fed would stop tightening. They might even start doing QE again. So the liquidity taps would carry on. And I think markets are very much in that kind of mode where they think that there's still that support coming through. And I think a lot of it comes down to the fact there's a lack of inflation out there.
I was trying to Andrew was sort of one sensed, or at least I sensed, I don't wish to put words into his mouth, that he was presenting a slightly rosier picture because the sun was shining or something, or he'd got out of bed on the right side this morning, than perhaps he truly felt. That was my slight sense. Forgive me, Andrew, if you're here and you disagree. But you know that the question of U.S. interest rates and the recession, which he nevertheless was talking about on the new neutral 3 to 5 year basis. I'll ask you the same question. If there's another couple of interest rate hikes in the U.S. this year, how convinced are you that the first move next year would continue to be up rather than be down?
I'm still pretty confident about that. I think there's still some way from normalization. I mean, all the Fed models are saying that given the state of the US economy, the amount of growth, the level of unemployment and so on, interest rates do need to be higher. So I would still say that you would need to have another rate rise. I think if you don't get that, I think it's going to be coming from some external shock. You know, maybe it will come from China having a hard landing. Maybe it will come from another downturn in the Eurozone or something like that. I think the US itself looks as though it's on a reasonably set path. Where I agree with Andrew is I think that the peak in interest rates is probably going to be lower than many people think. So you'll get another rate rise, but you probably won't get much more after that. I just don't think the economy will be able to take it.
Louis, sorry to turn to you last, but we have a lot of panelists here.
My pleasure.
Comments on what you've heard so far from either from your fellow panelists or from Andrew Balls, and give us your perspective, having been a central banker.
I've never been a central banker. I've been just a banker for central bankers.
Well, you were at the BIS.
Yes. Look, in terms of geopolitical risk and economic risk, where markets are, I think the markets are in the right place where they should be now. Because while there is clearly increased geopolitical risk, as some have mentioned here, the economic policy risk has been really damped since the crisis, because the central banker that we were serving at BIS have done quite a good, even in certain cases, a superb job, and basically providing liquidity where it was needed, for the time it was needed. Now, we shouldn't make any mistake, and we at State Street see a clear move. On your question, when is the Fed next move, up or down? We do believe it's going to be up, and because markets are not there to please market, central banks are not there to please market. They're there to make market function and to actually help through monetary policy the real economy. That's what is going on, and the Fed is seeing maybe something that we don't see in terms of, productivity growth. Maybe they know something, or they expect something from the fiscal side from the new US administration. But what they certainly see is that one of the side effects of this plenty of liquidity period is very high valuation and risk on. They may be displeased with that, and they will slowly carry on a de-risking from their end, I think.
Let me stick with you and ask you, you sort of had a little run round the conceptual idea. Specifically, where do you locate today the most worrying political risk and market risk? Those might be the same thing, but let's assume that they're two different things.
I guess for us, at least for me, the most worrying political risk is the withdrawal from the United States from a leadership position. At one point, there will be some reckoning and some cost. We have lived in a Pax Americana for many decades, and if you take a long-term view, if the US is withdrawing from this risk, somehow the risk will increase and the cost will be burned. But for the time being, in terms of economic policy, we still think that central banks are about the only game in town, and the market is seeing that and pricing that in their assets, in their valuation. At one point, this will change, and the geopolitical risk implied by this, evolution will be born somewhere and will manifest itself.
Okay, so it's
that's
the US.
What keep us, and also maybe in the US, the discrepancy between what is now monetary policy, and the noise that we hear about potential fiscal stimulus, which may not be exactly at the right time in the cycle, and which may create a
So
disconnect
they may hit
between
that, they may
monetary
open
policy,
that tap at the wrong moment.
yeah, between monetary policy and fiscal policy. We don't think we are at the end of the cycle.
John, give your two locations of risk, market risk and political risk. Do you agree the US is maybe both?
I think the US, I think the US probably is both. I think I've got a lot of sympathy with Andrew's view in terms of where the terminal Fed funds rate may go. My sense, though, is that we have an expectation priced into the market of about a 1.75% Fed funds rate. I actually think that's wrong. I think the market actually thinks it's either going to be 3 and a bit or 0. That's what I think it is. I don't think it's a true expectation. It's just
Isn't it just averages working?
Yeah.
Is that like you've got one hand in the fridge, one hand in the fire? That kind of
so I actually think that the market risk ultimately comes from the Fed doing a bit more. One of the reasons why we had a very strong equity market in the last couple of years before this year was because of a very, very low bond yield causing price earnings multiple expansion. So we had a profits recession. The reason why equities went up was because the bond-based discount rate you apply to equity earnings was boosting earnings multiples. Now, in a world where you get a higher terminal Fed funds rate than the market prices in, unless you get very strong corporate earnings, that may well be an issue for equities, particularly as Keith says, the defensives, which have led a lot of this move in the last few years because they are viewed as highly rated, strong cash flow generating companies which trade like bonds. And in fact, we've been in a world recently, and this is the madness that you describe, that people have been buying equities for income and bonds for capital appreciation. Mm-hmm. I mean, that is a world of misallocated capital. So I'm a bit concerned that things end badly, but I don't think they're going to end badly for at least another couple of years, because I think we've got at least another 2 more years of this cycle. Yeah. Because we aren't late cycle. I think we're in the mid stages or the latter stages of the midpoint of the cycle. In terms of politics, yes, absolutely. I think that it's the lack of leadership from the US which could give rise to some adverse outcomes. But at the end of the day, I still believe for the time being, for the next year or two, that the market dynamics will trump the geopolitical risks.
Was that a pun?
Yeah,
it wasn't intended, but it came out that way.
Okay.
Right.
It's very Churchillian.
Sebastian, there is a new confident president bestriding the world with a very firm handshake. Everybody has madly fallen in love with Monsieur Macron, haven't they? He is the darling of the world. Even though it's worth pointing out, I'm afraid I can't resist this, the entire turnout in the French parliamentary election was exactly the same as the proportion of the vote that Theresa May got when she became Prime Minister. But nonetheless, everybody thinks that she lost and he won. But still, that's democracy, folks.
No,
Where are you locating political risk?
That's
and is
mathematics.
France... What?
That's mathematics as well.
It's mathematics, exactly. And you're not even French.
No, not even.
It looks as though it might be, but he's not. You're Belgian, right? You're Belgian?
Yes, thank you.
Where are you... Well, first of all, I know it's very unfair, but this is the unfair question I promised you, ask a French bank. Are all the problems over in France, is there going to be love flowing back and forth across the Rhine, a new Europe, a new love in between Macron and Merkel, everything's going to be fine? He likes older ladies anyway. So.
Yeah. Okay, I mean, I think, and to make the transition with what my colleagues on the panel said, what Macron has created, or what that election has created, is reduced uncertainty. And I think the biggest political risk is uncertainty. Uncertainty in terms of, the fiscal policy, regulation, what could happen. So effectively, if we becoming a little bit more serious about your question, the fact that we can see potentially in Macron and in Europe a stronger leadership, potentially helped, I would say, by Mr. Trump, could solve a few things.
Helped because Macron looks even better when placed next to Trump. Is that what you mean?
Yeah, and stronger, right?
Okay,
it seems,
fine.
as we've
I
been
thought
told,
we'd just
right?
get
But,
that out into the open. Yes,
indeed,
okay, fair
indeed.
enough.
So, yeah, to answer to your question, I think that, you know, this is, I mean, back to the title of our panel, this is effectively, you know, a new global order in the sense that probably with what happened also last week in the UK, we're moving towards, you know, a different dynamic in Europe, which probably will help stabilize, if I'm a bit controversial with what has been said before, rather than, you know, destabilize. So maybe we see a little bit more certainty in terms of the direction, which should help us, you know, reduce the volatility that you know, the volatility that we have seen. And if you move then, you know, to the market, it should help, you know, reduce also the market risk or the perception of the risk. And I think, you know, as we are, you know, what I see in myself, you know, in the job, in my job at the moment, is the biggest risk that we see on the market is effectively, you know, the fact that, you know, the yields are very low and the spreads are very tight. And probably if we have, you know, a bit more direction from a political perspective, from the regulation perspective, it should help probably stabilize, you know, the full package. So I don't see that antinomic. I see that as complementary.
Oh, sure. Well, I mean, there's nothing wrong with being optimistic, Sebastian.
Yeah, sure,
I mean,
sure.
France and Germany getting on well together and cooperating economically is an extremely good thing from almost everybody's point of view.
I think I'm very proud of Macron and what he's helped the world do. Now there's more centrist movements. There's a greater focus on what the possibilities are. But I'm worrying that the expectations are very high of him and what he could possibly do. I think he's navigated it well in having a much more inclusive government. But I do think that the aspirations of people, which is really what's driving the challenges, are much higher than what the possibilities are. I actually think that the US may be in a better place because notwithstanding some of the uncertainties, we know for sure that there is going to be regulatory relief. We know that if there's regulatory relief, it supports the financial sector, but more particularly banks, and so that hopefully that should help in lending. I do think that, as one of my colleagues on the panel pointed out, that, you know, monetary policies probably reached its capacity, and therefore we're going to start to see a focus on fiscal type issues. And with President Trump's pronouncement about infrastructure, I think that the US seems to be able to be in a better place to navigate some of these issues better than Europe. But I do hope that Europe is truly on the path.
So let me ask you the same question as I asked a couple of these panelists here. Where do you locate risk, Arunma?
My big problem is that there's contagion. And so it's almost like it's a domino effect. When something happens, it affects everybody else. So I feel that the politics is probably the issue to worry about. But
I realize it's difficult for you being a representative of the World Bank, but can you...
Oh, I think you probably said what I really wanted to say.
but politics where?
Everywhere.
Everywhere.
Yes.
What we need is a new planet.
I think we have a new order. I think we have an order where the citizen is driving things.
And that's good, right?
I actually think it's a great thing. I think that, and you know, I hope we get to talk about technology. I think one of the benefits of technology is that it's empowered the citizen to be more demanding of its leaders. And what happens in one place, you can immediately see the next minute. And so you can ask of your leaders what you're asking, what leaders are being asked of anywhere else. So I think it's a good thing.
Okay. Moritz.
Yeah, well, when we talk about political risk, I mean, there's political risk everywhere, of course, and always has been. I mean, that's a constant. But I think it's not quite right to say it's all the same. We've been talking about the U.S. But actually, if we look at the U.S., what we observe is that there is uncertainty, but much of the uncertainty is actually harnessed by the institutions. So what you have is that the constitutional reality and the checks and balances that are built into the US constitutional environment are actually being tested, and they seem to be fit for purpose. So I think there is actually something positive to be taken away, because if we look at all the policy measures that people have been concerned about, starting with trade, but you know, depending on which side of the aisle you're sitting on, going on with taxes, going on with health, and on and on and on. Actually, you know, not that much has happened. So I think we see the constitutional order sort of in practice, sort of dealing with these situations and these challenges in a rather good way. What I find actually quite remarkable, we're now 2 hours in the program approximately, and the word Brexit hasn't been said. So I think this is, because, you know, you can say about the US sort of one thing or the other, but this by and large is likely to be a transitory phase. Brexit is something much more permanent, and it actually has a sell-by date, and we have very little time. The stakes are extremely high. When you may remember that about a year ago, right after the referendum, we lowered the UK's rating from AAA to AA by 2 notches, which is quite unprecedented. It remains negative on the outlook. So we think that the risks here, right here, are actually sort of much more significant and much more tangible than what we see either in the rest of Europe or the US. And it's remarkable, it's almost a year that since the referendum, that there still doesn't seem to be a clear direction or plan of where the country is hoping to go. And we don't have very much more than a year to negotiate. And then they started yesterday, and there's so much ground to cover. And it's just, I mean, if anyone can sort of describe sort of how this can all be dealt with and digested in the time available, I would be happy to hear it. But I think the uncertainties from this perspective are really outsized.
I did actually mention it in my opening remarks, I have to say, but it's partly because, of course, I was just about to say to
Other
Keith,
than that example.
I was just about to say to Keith, as a British person representing a British institution, we probably better had talk about it, although we're so modest in this country. We prefer not to raise these self-referential matters, but there is a suggestion that it might affect, you know, the amount of Prosecco the Italians sell or BMWs that the Germans sell. So, Keith, where are we on Brexit? And sterling, for that matter?
Well, I mean, the UK is somewhere where political risk still very much exists, and we can see that in the performance of the pound. I think in terms of what's happening in the economy, the uncertainty and the negative effects from Brexit are now beginning to impact the economy. Some of that has come through from the rise in inflation from the fall in the pound, which is squeezing consumer incomes. But some of it is also coming through from the weakness of business investment, which remains very flat because people don't know what kind of trade deal they're going to get. They don't know how to plan for the future. So, you know, the economy is struggling, and I think that it's going to remain fairly weak, actually, over this period of negotiation over the next couple of years. Because
the immediate aftermath, which obviously began a year and 2 days ago,
yes.
The immediate aftermath was thought by many to be imminently apocalyptic, wasn't, and therefore people have relaxed a lot more. That's presumably a false period of relaxation. The immediate apocalypse was really never going to happen. It was always going to be a slow burn, or, well, is that your view?
Economists made a mistake in that they thought that the reaction of the Brexit vote would be that consumers would immediately cut back on spending and we'd get a recession. Now, of course, what economists kind of forgot was the fact that people voted for Brexit, so they weren't actually going to be voting to make themselves worse off. And they took the view that, you know, what economists were saying wasn't necessarily going to come through. I think there's a question of lags in this. I mean, clearly we saw the pound fall, we saw inflation rise, we saw incomes get squeezed, and then we get the other uncertainties that I mentioned earlier about business investment and spending and so on. So I think the effects of Brexit have come through. They've just taken longer to come through. But it's difficult now to see how things are going to change. I mean, there's a certain amount of optimism that the fall in the pound will result in much stronger export growth, much stronger trade performance for the UK. But that doesn't really seem to be coming through in the data. You look at net export growth, it's not really improving. And of course, you know, businesses find it hard to sell when their biggest export market still doesn't, you know, we don't know what the trade deal is going to be in a couple of years' time.
John, you represent a largely domestic asset management house with lots of UK clients. How are you advising them to behave?
Regarding Brexit, we took the view that the likely outturn would generate a significant ease in financial conditions in the UK. And I think that what we saw in the immediate aftermath of the Brexit vote, with the move in sterling, more QE from the bank, base rate cut as well, that was probably the biggest one-off adjustment in terms of UK financial conditions that we'd seen since I was a very young man working in the Bank of England in 1992 when sterling left the exchange rate mechanism. So, we always took the view that the UK economy would grow at 2% or so for last year. We were one of the few people to actually call that. I agree with Keith, this year it is a bit more of a challenge. The view that we certainly take is that we will see something between 1.5%, maybe 2% this year, possibly a bit of risk that we end up close to 1.5 than 2. I certainly view business investment and the position of the household sector as being a potentially vulnerable area, just given the fact that the savings rate has fallen quite substantially. But from an investment perspective, we take the view again that risk premium is very high. If you look at the earnings yield on the FTSE, it's at 4%, 10-year gilts are at 1%. The guidance that we give to all our managers and to our clients is that you should still own equities rather than bonds because they're fundamentally cheap. And we're not calling for a big rise in bond yields this year, although we think bond yields will rise. And therefore, the focus certainly has to be on an pro-equity view.
And what's your house view on the likely economic outturn or the factor Brexit? What will it look like? I mean, it's fair to say that one of your senior strategists, John Redwood, is an ardent Brexiteer.
I'll plead the Fifth Amendment on where I sit on that.
So I don't know if his view permeates the firm, but I mean, do you foresee a happy ending?
I'm actually agnostic. John and I work closely together in a very constructive way, and we agreed on the facts that cyclically this would be quite positive for the economy. Going beyond that, I'm still not sure. I can think of positives and I can think of negatives. I don't know what the outcome's going to be because we haven't even started discussing the future nature of our trading relations with the EU and the rest of the world. So it's one that's very difficult to call. I mean, the UK is an open economy. I think that the global environment's going to be as big a driver of the UK outlook as the domestic situation. And if you're an equity investor, a large proportion of FTSE 100 earnings come from overseas anyway. So, if you're an open economy with a free-floating exchange rate in a global environment, you need to focus much more closely on the outlook for the Eurozone, which I think is quite constructive, and the global outlook, which again I think is fairly supportive. Whether we're an underperformer or an outperformer, it's too early to say.
Louis, or either of each of you in turn.
We'll fight.
You're both good Europeans, so what's your prognosis for so-called Brexit negotiations as just begun yesterday?
Prognosis. This is a one in history. It's a difficult one. On the economic development of the UK, obviously the State Street House view is pretty guarded and would agree with my neighbor on my right. It's very difficult to call. From my point of view, I think the Brexit evolution for the UK is going to be extremely challenging economically. I mean, in the UK, when you devalue, obviously it helps your economy, but for the wrong reasons, not because you have improved the tool of productions, whether in service or industry, just because you have a price advantage. But in terms of pricing of economic standards and level and so forth, actually, your net worth has diminished by 15% or 20% in the case of the UK. So, and thinking about the UK as a export-oriented economy, which would benefit enormously from its exports growth, while when you look at the balance of payments of the UK, is not exactly an export economy, and it is actually making its own exports towards its main partners more difficult because of its political stance. Seems somewhat contradictory to me. So I foresee
not-
difficulties
you're
out of
not very
uncertainties. That's for sure.
Sebastian.
In Europe,
Sorry, let's just, because we've only got a minute or so left.
So let's hear the optimistic view, right?
Exactly.
Yeah, I see myself, and I will not judge. Being a French-Italian national, very difficult for me to judge. The decision that triggered Brexit in this country. But if you want to be optimistic, I see it a bit like what we discussed before as Trump, as an opportunity. I see it as an opportunity for Europe, and potentially for Europe with the UK to rethink about what we can do, and potentially what happened with the election, the parliamentary election also in this country, is a first step to it. So you talked about Macron as being a first step to get a stronger Europe, stronger Germany together. Let's see how the negotiations are going to pan out, and maybe we need to sort out a few things in terms of regulation, everything that hasn't been sorted out in terms of defense, in terms of recreating something that will be better. And if you think about it, the reason also I'm optimistic is because if you think about, 1 year ago, even after Brexit, everybody was saying, the Dutch are going to exit, the French are going to exit, the Italians, will exit. I know there are still some doubts.
Quittily and
Yeah,
Brexit,
quittily,
those things, yes.
there could still be
Could
some
still
doubt.
happen,
It's
yeah.
pretty clear that the Spaniards will not, effectively. So, yes, economically, I think my colleagues are better positioned to comment on it. I think politically and for what's needed, I see some opportunities there.
Okay, well, this is a nice optimistic note, more or less, on which to finish. But somebody on this side, Sebastian does paint a pretty picture. Things get worse, but that just teaches us how things ought to look when they get better. It's frighten the children to sleep with these horrible things like Trump and Brexit, and then everybody else will behave. Take that view, Keith?
To some extent, although, I think with Europe, there's a lot of goodwill, and Europe is doing very well at the moment, but, we have to remember that we have extraordinarily loose monetary policy in Europe, and that is going to change, and I think there's still a tension at the heart of Europe that Germany actually would like to get interest rates back to a more normal level, have some structural reform, and I think Merkel and Macron are going to have some very interesting conversations later on this year about the direction of Europe, because you still have a chronic problem of lack of growth. You have lack of growth in not just Europe, but in the world economy. I've said many times, I think the root of that is the lack of productivity growth, the lack of real wages. We've almost dodged a bullet this year in Europe. There was a lot of concern that we'd get a big populist move. It hasn't come through. We were in a better place, but I still think there are a lot of chronic problems to be resolved.
Okay, very good. The app poll. We forgot the app poll. Shall I do that now? I beg your pardon. I've forgotten what the question was. That we had a list of half a dozen people. There we are. Oh, well, yes, there we are. Sorry, panelists, we didn't talk about that. So, the most likely to retain the job, Angela Merkel. The most likely, Donald Trump, not terribly likely. The Emir of Qatar, not terribly. Blimey. Why does most likely to retain? Why do so few people think that Mario Draghi is going to retain his job? He's supposed to be there for years. Okay. Well, what does the next question say? The least likely. Right. I think people don't know what the word retain means. Okay. Oh, I see how it's working. Right, I'm getting with it now. All these mathematicians and statisticians on the stage will do a much better job at analysing this than me. Okay, so Theresa May is very unlikely to have her job in a year, and Donald Trump is pretty unlikely, and everybody else will. And so let's go back to the other slide again. The previous slide. And the most likely to retain the job, everybody thinks Angela Merkel will be there. Okay. So it's good news for Angela Merkel, and it's bad news for Theresa May. Well, I think perhaps we could have predicted that. Anyway, now you all know how it's working. Sell May and go away. We're going to have a quick few minutes turnaround now, aren't we? We have two pairs of panels coming up next. In this room, we have the European Stability Mechanism, and in the adjacent room, we have Rethinking Bank Financing. So I'd like you now, please, you've got just a couple of minutes whilst we move the chairs around. I'd like you now, please, to make your choice and thank these excellent panelists for their contribution. Thank you.